Every week, two stocks hit new lows for reasons that aren't always obvious. In this series, we break down what's behind those moves so you understand what's actually driving the market. This week, the list of new lows is tiny, but it says a lot. Almost no companies are breaking down right now, which tells us the market is still strong. But the few names that are sinking share a theme. Investors are getting way more selective, especially with tech and high valuation stocks. Today we'll look at two companies at 52-week lows for totally different reasons. What do their stories teach us about how the market is shifting? Let's start with the most interesting one, MicroStrategy. It's way more than just a Bitcoin story. MicroStrategy has transformed from a software company to a leveraged Bitcoin holding company. The real story here is how the company makes money from Bitcoin. Here's how it works. They sell shares or preferred stock when the stock trades above the value of the Bitcoin they hold. Most of that money goes to buy more Bitcoin. A little goes into a cash reserve to cover interest and dividends for the next year or two. The preferred stock is clever. They don't have to repay it like regular debt. They can even skip dividends without going into default. But it's not free. It costs them 8 to 10% a year. Basically, MicroStrategy works as long as two things hold. Bitcoin keeps going up, and investors keep paying more for the stock than Bitcoin is worth. If either breaks, the whole thing gets shaky. This setup explains why MicroStrategy is hitting new 52-week lows now. Bitcoin has softened, and the stock premium to Bitcoin has shrunk. That weakens the company's engine for growth. There aren't really traditional financials to dig into here. The only analysis necessary here is your belief in Bitcoin and MicroStrategy's financial engineering. MicroStrategy isn't just a Bitcoin trust. It gives you leveraged Bitcoin returns. They borrow money through preferred stock to buy Bitcoin. As long as Bitcoin keeps growing at 20 to 30% or more, the strategy works. If it doesn't, the leverage starts working against them. They also rely on investors buying the stock above the Bitcoin NAV. The whole model only works if people believe the company can keep financially engineering more Bitcoin. But when someone talks about engineering wealth out of thin air, I get suspicious. The way MicroStrategy's CEO talks, it sounds like anyone can get rich with his products. It's wild that this is widely accepted for MicroStrategy. Meanwhile, supposed circular financing schemes in AI have received way more scrutiny. There's no traditional valuation here. MicroStrategy's value comes entirely from Bitcoin and how they leverage it. To me, this is pure financial engineering. The stock only works if Bitcoin keeps climbing and investors keep buying above NAV. And that's a big if. It's a high-risk, high-reward bet on both Bitcoin and the company's ability to keep raising capital. My take, if you're extremely bullish on Bitcoin, it could pay off. For everyone else, a Bitcoin ETF like IBIT is a much simpler and safer way to play it. MicroStrategy's biggest risk is its financial engineering turning against them. If Bitcoin stops appreciating, the company starts taking losses from its preferred shares. There's also risk for people buying the preferreds. It might seem safe, but with the company able to pause preferred dividends, you need to be very cautious about relying on those payments. MicroStrategy is an interesting financial engineering experiment that pushes the bounds of traditional finance. I might consider buying if the NAV ever drops below the value of its Bitcoin holdings. Now, let's switch gears to something much more grounded. Procter Gamble, a classic consumer staples giant. Procter Gamble is a classic consumer staples company. They make the everyday products people buy no matter what's happening in the economy. Detergent, diapers, razors, toothpaste, skincare, and more. It's the definition of a slow, steady business. But right now, they're dealing with a tougher environment. Inflation has squeezed consumers, and competition has picked up across several categories. To respond, Procter & Gamble launched a 2-year restructuring plan. They're cutting costs, trimming parts of the portfolio, and trying to make the organization faster and more focused. The goal is simple: get more efficient so they can invest even more in product quality and marketing. And that matters because consumer behavior has shifted. Yesterday, we talked about people trading down at dollar stores, but Procter & Gamble is seeing the exact opposite. Consumers aren't trading down, they're trading up. Private labels are losing momentum, and shoppers are going back to the brands they trust, especially in health, home, and family care. So even though Procter & Gamble is a low-growth, boring business, there's still a real battle to keep customers and protect profits. Right now, Procter & Gamble's data shows higher quality products are the key to winning that battle. Now, let's look at what the numbers say. Procter & Gamble is growing, but just barely. Last quarter, sales were up low single digits, and most of that came from higher prices, not from selling more products. Volumes are still soft in a few categories, which shows consumers are being selective. And that's the core of why the stock has pulled back. Investors treat Procter & Gamble almost like a bond. The company pays out nearly all of its free cash flow through dividends and buybacks. You usually get around a 4% shareholder yield and about 3% annual growth. That adds up to a 7 to 8% total return. Exactly what long-term investors expect from a stock like this. But if that growth number slips, the math changes quickly. If Procter & Gamble is only growing 1%, investors need a higher yield to hit that 7% target return. A 6% yield would mean the stock needs to trade closer to a 16 PE. That implies roughly 15% downside from here. Stocks can move for random reasons in the short term, but a lot of the time, it really does come down to simple math like this. Now, let's talk about valuation and where I stand on the stock. For valuation, we shouldn't be expecting market returns from a stock like this. Thus, let's compare it to the Vanguard Consumer Staples Index, which averages about a 7% annual return. I think Procter & Gamble can realistically hit 3% net income growth over the long run. That's basically just keeping up with inflation. Combine that with a 5% yield, and that's 8% growth. If the forward price to earnings multiple holds steady, that's a 47% return over 5 years. Not great, but better than a bond or your bank account. My take, I'd rather just hold the Vanguard Consumer Staples ETF and get the diversification. Procter & Gamble is fine, but the ETF gives you the same profile with less single company risk. Procter & Gamble's biggest risk is straightforward: low growth turning into no growth. That's when the whole steady 7% return model starts to break. For that reason, unless the stock is trading at a significant discount, you're usually better off with the Vanguard Consumer Staples ETF. There's just no compelling reason to buy Procter & Gamble stock today. The main takeaway from Procter & Gamble is that sometimes the sector ETF might be the better play. But this is a great look at how companies behind that ETF actually operate. So, to wrap up, these two stocks sitting at market lows are actually two very different ways to play the market. MicroStrategy is a high-risk, high-reward experiment in financial engineering relying on Bitcoin growth and investor enthusiasm to drive returns. Procter & Gamble, on the other hand, is a steady consumer staples giant, but it teaches us that maybe the sector ETF is the better play. The key lesson? Know what you're buying. Are you chasing growth and willing to take risk, or are you seeking stability and income? Each strategy has its place. That's it for today, guys. If you found this helpful, hit like. And since you stuck around this long, join me on Discord. Link in the description. Please talk to me. Thanks. Bye.